Good morning, everybody. This is Patrick MontesDeOca, CEO of the Equity Management Academy Live Trading Room. What I would like to do on this special weekend report is to basically review the monthly and the yearly indicators that we are using to trade in the gold market. We are using the VC PMI, which stands for a variable changing price momentum indicator, for our day trading, swing trading, and position trading. And on this report, what I would like to do is to concentrate on the monthly and the annual signals and see where the market is in relation to these indicators. The price of gold closed at 1586.90 here on Friday the 14th. And as we take a look at the monthly VC PMI, it's at 1578, and therefore the market closing above 1578, it has activated a bullish price momentum. Now, the VC PMI, or the average price, is a standard 50-50 deviation, and so therefore it could go either way. And what I do pretty much in order to apply this indicator in my account here in Tocker, I basically wait for the highest probabilities to identify the signal. And that is essentially when the price is at the blue level, as you see here, even on the annual number. The low of this move was 1302.40 on May 30th, 2019, and not quite coming down into the annual expected buy level of 1268, which was published on September 28, 2019. The annual numbers were published to give us an idea of the structure for the period September 28, 19 to September 28, 2020. And what we do is, when we trade the VC PMI, we use the daily, weekly, and monthly indicators to identify the harmonic relationship, or the perfect alignment, you might say, between them, as the price pretty much goes to par on all the three trends. When that factor is identified, it provides the highest probability trades mathematically. That means that all the three trends have been aligned almost at par, if not at par, which means at even money, or at zero basically, or the same price. It identifies the possibility that the reversion to the mean could begin to unfold, even on all the three trends, changing the dynamics potentially of a trend and identifying a trend reversal, or a longer term trend perspective. The fact that the market closed above the average monthly price of 1578, we're coming into the rest of this month with a bullish price momentum, and this pretty much activates the monthly target above the mean, which is 1630 for the remainder of February. The sell one level is a mathematical probability that is a 50-90% standard deviation. If the signal is activated, basically it identifies a 90% probability that the price will revert back to the mean. If it doesn't activate a short trigger after confirmation, the next level above, which is the sell 2 level, activates a 95% probability factor if the signal is triggered. On the other hand, the VC PMI also tells you that if the market closes below 1578, that it goes neutral. It neutralizes the bullish price momentum to neutral. And so at the same time, it activates the level above. I'm sorry, the level below of the buy one level of 1536. The buy two level is 1484. So what can we expect as we come into next week and the remainder of the month is that based on the artificial intelligence of the algorithm and the price closing above the monthly average price of 1578, it activates the sell one level of 1630 to the sell two level of 1672 as targets. As we come in to next week or next month and the price closes below 1578, it negates this bullishness to neutral, and another close below activates the bearish price momentum, activating the buy one level of 1536 to the buy two level of 1484. If we take a look at the right of the chart and we analyze the annual artificial intelligence of the VC PMI, or the variable changing price momentum indicator, is telling us that because the market closed above the annual average price of 1418, that the sell one level of 1654 has been activated. And so the price protection for the annual indicator is a close below 1418, 1417. If it closes below 1417, it activates the annual target below the mean of the buy one level of 1268 to the buy two level annually of 1031. Recap. What I have done here is show you the comparison of where we are in relation to the monthly supply and demand levels for the gold market. as well as the annual seasonal structure as we continue into the first quarter of 2020. My opinion, based on the intelligence of the VC PMI, the monthly and the yearly indicators are in a bullish price momentum. The daily indicator gives you a protective stop on a close below 1578 that would negate this bullishness neutral. If the market closes below 1578, it activates the monthly targets of 1536 to 1484. Before I make any additional interpretations of the artificial intelligence, what I want to see as we come into next week and the rest of the month is how the price reacts basically from where we are right now. We are in a neutral to bullish position, and a close below 1578, which is not far from where we are right now, could activate this monthly levels below of 1536 to 1484. I'm sorry, to 1484. And what I would like to see actually is the price action define the supply and demand, basically, activity that we get as we come into next week. Either we're going to find additional buyers that will bring the price up to the previous target of 1619 made on the 8th of January, which I believe was the missile, the Iran missile effect. Then we're looking at market approaching that 1635 to the annual target of 1654. If for some reason we get a spike move up into this price, I strongly suggest that you lock in your profits, that you reduce your position or hedge as the targets annually have been completed, the monthly targets have been completed, and obviously all the shorter term targets, the daily and the weekly as well, have been completed. The price action is the element that activates the trigger points using the VC PMI structure. It gives us a scientific, methodical way of approaching the market for day trading, swing trading, and position trading.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VC PMI, is an automated AI trading system developed and tested over a decade. The VC PMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory trend analysis, pivot points, and several other widely accepted financial analytical methods. The VC PMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VC PMI algorithm. The VC PMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VC PMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VC PMI? The VC PMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VC PMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VC PMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.
Yeah, sound advice. I'm speaking with the founder and CEO of the Equity Management Academy, Patrick MontesDeOca, who runs the Mean Reversion Trading Marketplace service here at Seeking Alpha. You can sign up for Mean Reversion Trading either by going to seekingalpha.com/marketplace and looking for Mean Reversion Trading, or by typing Mean Reversion Trading or Equity Management Academy into the search bar at the top of the site. Okay, so you mentioned risk management, and of course the system that you're using here is probabilistic, which means that it's not going to nail the direction 100% of the time. So what sort of things do you do or recommend to people via the Academy to manage risk?
Well, first of all, when you go in, let's say we use the factor of the principal investment equals X. Okay. And so if you have the X factor clear in your mind and that equals 100%, okay, then depending on where the algorithm is in relation to all the trends, for example, you can begin to activate percentages based on that. For example, if we were to be in the market yesterday in the metals, and we recommended to get out and to be looking for a reversion, okay, to occur. We went flat, and basically we identify the three trends, the daily, weekly, and monthly trends, to be almost at the same price. When the price came down below the critical level that we look at, it activated the reversion. And so that was a time that it identifies for you potentially a trend direction short term, and it could be a duration of maybe a couple of weeks generally, until the prices come back down to align themselves on the B1, B2 level, or the level of demand. You with me? And harmonically aligned itself into the daily, weekly, and monthly numbers once again, which will be at the extreme below the mean. And so those times are times where you can manage your position a little more aggressively, when you identify the harmonics in the trend. Did I answer the question?
Yeah, I think so, definitely. So in terms of you are using this system to trade S&P 500 minis, gold, and silver, and just have to ask why these three assets.
Let me for a minute finish this question regarding the risk, because when you identify the portfolio of 100%, let's say that you want to commit to the market, then if you have, for example, a perfect alignment in prices like yesterday in all the three trends, then you could be buying, like I was for the mini, the bear ETF, which is the SPXS.
Right. Well, is that the ProShares? It's the
That's the
triple.
bear. That's the
triple
three to
leverage.
one.
Uh-huh.
It's a triple leg. Yeah, exactly. So because I'm an aggressive trader, you with me? I want to play the aggressive play, and I'm expecting the prices, like I said to you, based on the VC PMI, is anticipating a reversion back down into the Harmonics or blue again. I want to ride this, the SPXS, which is the bearish ETF. And that's where I've been trading for a hedge fund that I'm managing, which, by the way, is up about 10% for the year so far. And I'm applying, actually, the automation of the VC PMI to manage the fund.
Nice.
Except that I'm using that in security. So what I'm showing here is that the signal, although it's a directional signal in the futures markets, the application can be exponential based on your size, based on your particular situation individually.
Sure. And so is everybody basically just trading the S&P 500 gold and silver, or can this system be effectively applied to other assets also?
To answer that question again, I'm sorry. Yeah. First of all, the answer is yes. It can be effectively applied with same probabilities, because the program will adjust to the volatility of each individual market. And the data that it will provide will be based on that.
Sure, although I understand that.
Okay, so
I would assume the underlying volume in a given asset would determine how robust the probability is.
That's exactly the reason why I trade gold, silver, and the mini, you see, because it's liquid, it's volatile.
Mm-hmm.
You with me? And for some reason, I'm finding that the relationship of the indices to the principle of the reversion to the mean is even more accurate so far than any other market that I've traded. And it may be that because it is a paper market, meaning stocks, and the futures itself is the underlying, is the paper, so to speak, than the commodity. So that the risk management is done based, once again, on where it is, where the price is in relation to the trends. For example, if it was yesterday, going back to where the price was in the metals, or the E-mini is, for example, you can use this position to accumulate, for example, the bear ETF in all the three trends. And this is where you may come in and take a 20%, 30% of your portfolio in this position. You see?
Uh-huh.
And so upon confirmation, you go into 50%, and so that eventually, when it breaks out up into the reversion completion, you should be long maybe 80-90%. But when it reaches the target, you liquidate 90-80% of that, and you go back to maintaining a very small risk position, or you liquidate all of it, depending on if it reaches the extreme level, you might say again, of the reversion to the mean above. If you buy it below and it goes all the way from B2 to sell 2, let's say, then yes, of course, then you lock in your profits up there. So it doesn't matter where the price goes, the market will give you a structure to trade from, where it identifies for you the probabilities above the mean or above the average with 90-95% probability, or below the market with very, very specific levels, and also 90-95% probability.
Sure, and you have tight stops in place, I would assume, on the upside and downside?
See, when you enter the trade, automatically the stop is identified below. Like I said to you, on this trade that was done earlier,
mm-hmm.
the entry was 27.75.
Mm-hmm.
The stop was 27.76.
Yes, but what if it moves in the opposite direction, downwards?
If it closes below 27.76, you get out. If you didn't take profits today, when it gave you
mm-hmm.
the chance, the close below was 27.75.50, so you'd be stopped out.
Gotcha. Okay.
at 27.75.50. Your entry point was 77.75. That's your risk. You're flat.
Gotcha. Okay, cool. Gotcha. Yeah. So that's the risk. The risk control is happening through very tight stops.
And in other words, when the order is activated, it immediately activates the stop above or below, or the target above or below the signal. Immediately.
I said I was going to ask questions about what vehicles what your preferred trading vehicles are for gold.
The JNUG for gold.
Okay.
That's a minor ETF, but it's XXX. It's the bull.
Sure, although it's not direct. It's fairly directly correlated.
The underlying
to
is the GDXJ, which is 1-on-1, and it does follow very closely the futures price. And because it is a XXX ETF, as I said, I'm an aggressive trader, so we're talking about the way that I manage the risk. And because I have the tools to help me manage the risk, which is the VC PMI, then, you know, when I get a directional signal, let's say in the automation, then I apply the exponential application where I go in and I buy, you know, 1,000, 2,000, sometimes, you know, 10,000 shares of JNUG. And if I want to eliminate the margin, for example, okay, this is a very critical point. I recommend traders that trade the futures markets, regardless of how financially set you are, to day trade the futures markets and position yourself in ETFs, so that you can basically hold the position overnight. Because I don't care how well financed you are, trading in the futures markets can be treacherous, particularly in the Globex, you know. So if you, like, let's say like yesterday, or where we are now in the mini, for example, where the reversion is giving confirmation based on the action today, that is reverting back down possibly into that low 2,700. So how do I take advantage of that signal? Well, I don't like the futures risk. I got a confirmation of a short signal happening. You with me? Therefore, I can buy the SPXS ETF, which I did, and I covered it by selling calls way above the market and collect credit. So I'm done. I bought it. My average price is $22.50. I sold it at 25, 24. I collect, you know, a credit. I'm done. The market runs up there. It takes me out. I make a nice profit. If it comes down, it will eat the premium of the call, you and me, which I will keep, and I can always be writing against the ETF if that's the case. So it's a question of how you manage the risk, you know. And for me, as I said, I'd rather be long. I think the futures margin is, let's say, for overnight position, maybe it's about 10, 15,000, depending on your broker, you know. I'd rather take that money and buy the SPXS or the L, which is the long, and carry the position, because since these ETFs are XXX ETFs, when you get a 2 or 3% move in the futures price, they're going to give you 10, 15%, sometimes 20, 30% in a day.
Sure, yeah, and a super big move in one direction, definitely. And how long are you holding? You're saying overnight, but you're not holding these funds for
the day trades. I day trade the future and I get out at the end of the day. But if I want to hold it into a swing, I convert it to an ETF. And when I get my price, which is generally sometimes 2 or 3 days, I get out, you know. And so I'm building trades where I go in and I pick up a couple of grand here, a grand here, 800 here, you know, but I'm active in locking in the profits. Now, that's managing my position short term. Okay, so depending on where the market is, again, it will give you the opportunity for you to manage your position short term, put on a swing, and put on a position trade where you can buy and hold for a month, or, you know, if you're looking for a trend to unfold. Yeah. So the market will always tell you, and the relationship of the price between the trends will identify for you, you with me, the bigger picture in terms of the trend direction that you may have. Point in case here, the market is coming down 27.7150 on the ES, and the reversion now is on the weekly is working because the weekly signal came in short, and the target is 27.52, the first target. The daily already, completed the buy one target, and now it's looking at the sell two target of the buy one target of 27.66. Okay, hear me out for a minute. I just told you the buy two target in price is 27.66, and I told you the weekly average is 27.52, correct?
Yes.
When the price equals the same, that's what we call harmonics alignment.
Mm-hmm.
So we're very close to that. You see what I'm saying?
Yeah.
And that's how we connect the day trend with the weekly trend and the monthly trend. And it's purely mathematical.
Yeah, no emotion involved at all.
Yeah, exactly. You can hear by just the way I talk. I talk numbers. It's like explaining to you the multiple table, so to speak.
Totally. And sorry, just because you had mentioned silver also, is there a preferred vehicle that you use to trade silver?
I used to trade the USLV until they broke the stock, so to speak.
They rolled.
Yeah, I think it was 3-1. They split the stock, and it became very expensive. So the other thing I want to point out to you with regards to the metals here, which I think a lot of people that have been trading the metals have experienced, and that is in fact that the metals have been completely manipulated away from its equilibrium price, or its real mean, or its real average price. And which is what's been going on for the last 4 years. And so it's a different dynamic when you're trading in the metals, so to speak, than you might say the equity markets, because the silver market in particular is a very thin market. And large traders, bankers tend to use that market to control the price. The price of gold. If they can't move the price of gold the way they want to, they'll use the thin market like silver, for example, to affect the price. And so that movement is an artificial movement that has nothing to do with the actual function of the price of the market, because it's manipulated in that sense. But what the algorithm will do is it will identify for you when they get it to an extreme level. You with me? And when they get it to an extreme level, it will go harmonic again. The prices will link. And that's when the program will tell you, regardless of the energy underneath, regardless of the reason why the market went there, look for a reversion to occur, because mathematically, and the physics of the market of trading tells you it's reached an extreme of 95, 98. When the three trends are harmonically aligned, it's like 100% probability of the reversion to occur from there. And if you want to go trade against that probability, good luck,
Sure. So I had one other question I've been meaning to ask here, and that is, are there ever kind of extreme market conditions, let's say thinking back to 2008, 2009, or maybe even going back earlier than that, some of the market disruptions in the early 2000s or late 90s, or maybe 87, where the system just totally breaks down and your basic advice is just stay on the sidelines until things kind of straighten out here?
That's a very good question, because that's what happened to me in 2008. That I only had one algorithm, and when the market, for example, in crude as an example, I was long crude, and I had like a huge profit. I had like 100 and something % profit. Yeah.
I was going to say, is that when crude was basically over $100?
Yeah. For me, the program, had a profit, but it didn't follow. The stop didn't trail it. It didn't adjust to the volatility. And lo and behold, of course, when the market collapsed, I wind up giving all the profit, and I think I netted with about 23% profit, after being up so much. And of course the market collapsed in 2008, and I was a victim of MF Global. That 1.3 billion dollars disappear of equity funds, and unfortunately I had my business with them. The automated program was traded in their platform. I think it was Strategy Runner, and so.
And it wasn't FDIC insured or anything?
You can read about it if you Google it, and it didn't matter if it was insured.
Yeah, no, I don't remember the exact
very
logistics
painful,
of
very painful experience,
happened.
and you never get your money back. They give you nickels and dimes, if anything. But I always learn. I always have the philosophy: what can I learn from my experience? What is it that I can learn from here? And in fact, what I learned was that I had to take the algorithm, and I broke it down and created 3 different components, 3 different trends, 3 different algorithms out of that, because I had to break it down and find out how I can adjust the algorithm to the volatility of the market so that, the same thing won't happen. And so what I did is I adjusted the algorithm so that it will tell me when that happens. And when that happens, if you read closely in some of the instructions that I have in there, or the book that I wrote, usually when the price closes above the sell 2 level, okay, which is the extreme above the mean level of resistance, okay, the price will activate that resistance as support. It will convert that resistance to support, okay? And that support now connects to the weekly data. So instead of looking at the daily data, automatically, when it closes above sell 2, you look at the weekly data. You look at the weekly signals. And it tells you when it closes above sell 2, you don't sell to open. You don't go short to open. You only sell to liquidate. I'm sorry. If you're on sell 2, you don't buy to open. Excuse me. You don't buy to open. You don't buy to open. You only look to sell once you get the confirmation. Because, as I said, like say here, for example, today's rally was the sell 2 level is 28.01. Okay, that's the resistance today. That's the sell 2 level. If the price had closed above 28.01, it would convert that resistance to support. And that sets the price fractal higher, and then it falls into the weekly and the monthly patterns. And you with me? And for example, like in the gold yesterday, that happened, and then you looked at the monthly data because the weekly broke above the sell 2, and the weekly the monthly sell 1 level was 27.98. So when the price of the daily closes above sell 2, you look at the sell 1 weekly, where it is in relation to that. And more than likely, it's going to be pretty close or above it. Particularly if it's harmonic, is what I'm saying. You with me? And then if the weekly closes above the sell 2, then you look at the monthly.
Yeah.
And so when that happens, you are going to find that all the 3 trends are in red, are in supply. Like in the E-mini yesterday, like in gold yesterday. And that tells you the system is going to change. And don't... in other words, it can go higher. It can go into that weekly sell 1. You with me? And so it tells you now, on the daily, if it closes above the sell 2, you don't open positions to go short there because it can go higher. You wait for the market to correct to the buy 1 or buy 2 levels of demand to get long.
Sure. So there's really a lot of positioning and repositioning happening over the course of the day in this.
If the price is what dictates that.
Yeah, sure.
You see, and so, but there are only certain strategies that the market will do up or down, or sideways, that within this structure is my point. And I know it's very difficult to comprehend, what I'm saying to you in terms of understanding the dynamics of the harmonics that we talk about, but it's basically the price equals the same on all the 3 trends, and when that happens occasionally, maybe a couple of times a month, is when the trend usually reverses. It tells us, the system has changed. You don't, if you want to day trade, then look to, when trend traders identify this, they usually say buy corrections only or sell rallies only. You with me?
Mhm.
It's that artificial intelligence that's built into the algorithm, and that is the artificial intelligence that I coach and teach self-directed traders. There is one thing that I've experienced here, which is basically to use the automation, as an indicator or as a tool, so to speak, for me to trade my self-directed account a little more intelligently.
Mhm.
It just makes all the sense in the world. I suggest don't let the automation, don't take it for granted just because it's automated that it's going to produce, $1 million for you overnight. You still have to manage it. Even pilots, when they fly the plane on automation, they still have a co-pilot watching it.
Yep, and in certain conditions, they got to take the wheel.
Yeah, exactly. Yeah, so you want to be aware, prepare, but this takes a lot of the stress out, the emotion out, and it makes you trade systematically, methodically.
Yeah, no, sure. Fascinating stuff. This has been really great,
I appreciate it.
I was wondering if you had any final words for our listeners before we go here.
I think one of the things that is important to recognize for me, for example, is that when I decided to become a trader, I decided to accept the responsibility of a trader. And that is discipline, consistency, how to manage your emotions and how to control your emotions. When you go into trading, look at it as a business venture. Like you're going into the business, like you're going into a business. And the business that you're going to is you're going into every business if you're trading commodities. You can be in the gold business, you can be in the silver business, you can be in the indices, you can be in stocks. Your business as a trader is every business out there that you feel that you can trade. Okay. But as a business, you want to specialize, you with me, and maximize based on your goals, objectives, profit margin, so that when you begin to run your business and you begin to show a profit consistency, a consistent profit ratio, so to speak, don't be greedy, emotional that when you have a profit, you don't take it, you want more, you wait, I'm going to get a little more, I'll wait a little more, or change your strategy from day trading to swing trading. Don't second guess yourself. Be very definite about your trades. Go into the market knowing exactly what you're going to do. Do not be influenced by the chatter out there. Try to be independent. Try to isolate yourself into the work that you do. Because if you do the work mathematically, math don't lie. Mathematics always tells you the truth, as opposed to fundamentals, as opposed to CNBC, which is trading blind. And so for myself, what I would say to you is, create a process for you. For example, just to share with you, and it doesn't mean that, you have to do what I do. Every morning I get up and I meditate for an hour. I run, I do yoga before I come into trading. And when I come in, I'm fresh. I'm completely clean. My thoughts are clean. You with me? I close my doors, and it's silence and me in the market. I have my tools. I have my numbers in place. I have my screens all set up. There is no stress. I don't need to worry about where the market is going. I don't need to worry about the chatter. I don't need to listen to the news. I only need to trust myself as a trader and try the tools that I'm working with. And so time and time again, as I've done this discipline, I have found that whenever I second guess it emotionally, as a trader, I will. And I continue to do that, because I'm human. I'm emotional. Every time I second trade it, it proves me wrong, as opposed to just following it, right or wrong. And it will not be right 100%. But if I can go in there as a trader and make 60-70% of the range that I'm looking to make, I'm happy. So discipline, passion,
Sure,
patience, and manage your emotions is what I would recommend.
Nice. Sound advice. I like that. I think that's a good place to leave off. Anyway, thank you so much for joining us today. This has been great.
Thank you so much, Jonathan. I look forward to next time.
If you've been enjoying the Seeking Alpha Marketplace Roundtable podcast, you can subscribe through iTunes, Apple Podcasts, Spotify, Google Podcasts, and Stitcher. You can also give reviews on those platforms to help other investors discover this podcast. We just spoke with CEO and founder of the Equity Management Academy, Patrick MontesDeOca, who runs the mean reversion trading marketplace service here at Seeking Alpha. You can sign up for mean reversion trading either by going to seekingalpha.com/marketplace and looking for mean reversion trading, or by typing mean reversion trading or Equity Management Academy into the search bar at the top of the site. You can also follow Equity Management Academy on Seeking Alpha and enjoy their free content there. For disclosures, I don't have positions in any of the funds mentioned in today's show. Patrick MontesDeOca is a day trader and thus may have positions in JNUG, JDST, SPXS, SPXL, as well as the futures of the S&P 500 Mini, Gold, and Silver.